I'm Ron DeLegge with ETF Guide. It's great to see all of you. Let's get right to it. I've got a few charts I want to share with you. Let's take a look at the big picture. This is since the start of the year, that's January 1st, all the way through the market close of April 17th. And this is your big picture view of the major asset classes and how they're performing. SDCI, which tracks a basket of different commodities, has been the best performer in this group. It's up just a nudge over 5%, and it continues to deliver strong results. As I mentioned, pretty much on a weekly basis, because SDCI is on our chart. This is a great alternative asset to stocks and bonds, and actually it's complementary to your stocks and bonds and other assets that you may own in your portfolio. And it's a great diversifier, and it's one of the best broadly diversified commodities ETFs out there. So check out SDCI if you're looking for exposure to commodities. This is a good one. BND, which tracks total U.S. bond market, also holding up pretty good. And then those other three areas, all in negative territory: global real estate, Bitcoin, and S&P 500. You'll notice REET, which tracks global real estate, it's actually been making a run here over the past couple of weeks. So we'll see if it can flip into positive territory. In terms of S&P 500 industry sectors, we've got 11, and the ones that are leading are all the defensive sectors. Things like consumer staple stocks, utilities, as well as real estate. This really is a perspective on the market's fear right now and just how defensive the mindset is right now by equity investors. We see the bottom performers, really the underperformers, led by technology, XLK, which has really struggled since the start of the year. We're going to take a look at technology for you bearish ETF traders. I've got some ETF tickers that you're going to want to put onto your list and onto your radar. In terms of other areas that are doing well, how about gold, which is at record highs? We see great performance not just from gold itself, but gold equities. Nugget, NUGT, and JNUG, JNUG, are both 2X leveraged ETFs. These are bull ETFs on the upside, both up over 100% since the start of the year. JNUG, of course, tracking those small cap mining stocks. Both have done great. Nugget, of course, the larger cap, more established mining stocks. But put those two on your radar, you bulls. You've also got GDX, which is an unleveraged version or unleveraged exposure to gold miners. And then, of course, GLD, which is physical gold. These two ETFs, unleveraged, continue to also perform very strongly. Now, in terms of other ETFs for you bears, and we mentioned earlier technology, we'll take a look at TECS, which aims for triple daily opposite performance to tech stocks. It has done quite well. Now, it's had a lot of peaks and valleys this year. It still has maintained, though, pretty nice performance since the start of the year, and the overall trend continues to look like it's down for the technology sector. TZA, which tracks small cap stocks, 3X inverse or 3X daily opposite performance, again, to those small cap stocks, has also been a good performer. A lot of weakness in that area. And then SPDN, which aims for 100% daily opposite exposure to S&P 500. That's unleveraged. That ETF has also delivered pretty strong results. And I would consider that one of these three, I would say the most defensive. You know, when you start using leveraged ETFs, that's 2X or 3X, you're all about offense. You're trading to make a profit. You're not really trading so much from a defensive angle or perspective. Whereas those 100% daily inverse ETFs, those are a little bit more, they can be used in a defensive type of setting. And so that's just something to keep in mind. Now, we talked about margin of safety investing. I did an episode for you last week, which was well received, where I outlined the types of assets that meet the minimum definition of safety. I created an entire playlist. There's 16 videos right now. It's continue to add to that library. You can hit the playlist link on this channel, and I want you to watch some of those videos. But retiring and investing with a margin of safety, it's all about having a cushion inside your investment portfolio. Of course, the older you are and the closer you are to retirement, or if you're in retirement, the bigger the cushion you need. Why? Because you have less time to recover from a major market event a crash, a crisis, chaos. You just can't afford to wait 20, 30, 40 years to have a rebound. So, and plus two, you're at the point of where you're starting to take money out of your retirement account. And so when you have that combination of depleting the retirement account with distributions, you're also depleting the account in a declining market. You really put yourself at the risk of running out of money, and that's something none of us should be in retirement. Now, we had some nice comments. One of them that I wanted to focus on was from a viewer named MVP111, who said that he loved the content. He said, awesome stuff as always. Appreciate those kind words, MVP. He's using, he or she, SGOV, trying to work up to 2 years of living expenses as the goal, which is a tremendous goal. Of course, the guideline is you should have about 6 months of living expenses set aside, 3 to 6 months. But 2 years is pretty aggressive. And SGOV is okay for your core and non-core portfolio. It's not really the type of ETF that I would use for your margin of safety, because the goal of this ETF, as you can see here, and I've extracted this from, this is a BlackRock iShares ETF. I took this from their site. And you'll see that the goal of this ETF is to track an index which is linked to Treasury bonds with a 0 to 3 month maturity. And so that's the goal of the ETF, is to track that index. It's not to protect your principal. It's not to guarantee your principal. It's to track an index. So just keep that in mind, MVP. Yes, I know Treasuries are declared the safest asset on the planet, right? Because it's got the full faith and backing of the U.S. government, but they still have volatility. And when you put those Treasuries in any kind of fund, you're never holding those actual Treasuries to maturity, right? Because those maturities, as those funds mature, are constantly being replaced by new Treasuries. And so that's, again, why SGOV, while it's an okay ETF to use as a alternative, short-term alternative to cash, and for your non-core or core portfolio, it's not something that I recommend or would use in your margin of safety. There's been calls for Jerome Powell, the chairman of the U.S. Federal Reserve, to be fired. Why? Well, one of the reasons is because he's not lowering interest rates fast enough. And I had to check my AI on this to remind myself of what is the chief mandate of the U.S. Federal Reserve. I'm the least of people to be defending bankers, especially federal bankers working for the Federal Reserve, because they do a lot of indefensible things. But ChatGPT reminds us that the U.S. Federal Reserve's two mandates are maximum employment and stable prices. In other words, controlling inflation, making sure that it's not too hot and not too cold, but right in the middle. One of those mandates is not covering up the government's policy mistakes. So as long as these government policy mistakes are creating more inflation, interest rates are not coming down. And so the Fed is kind of stuck in a hard place. Speaking of policy mistakes, I think it's important for us to remind you of history. Besides looking at charts of what's going on in financial markets, it's important that we understand history and the importance of protecting ourselves from the government's instability. And history, if you look at it very closely, uncovers a pattern of enormous policy mistakes by the government. And this is just a few examples over the past 100 years. I'm working on a book all about this, and I'll have more for you on that. But this is actually some of the research that I did, just looking at the past 100 years. And if you look at throughout the various decades, you'll see that the government made consistent policy mistakes on a massive level, from the 30s all the way up till now. And politicians lie, but history does not lie. And again, I think this is a graphic illustration of how the government continues to perfect its own mistakes. It seems like each new policy mistake or set of mistakes by the government is always bigger and worse with every new iteration. It's also important to understand from an investment perspective, when we start talking about our portfolios, retirement planning, that these events being triggered by the government are not rare or isolated events when we look at the big picture, when we look at history. These mistakes, if we look at it closely, occur with such alarming consistency that it's incredible and astonishing that anyone anywhere still trusts the government. And so I hope you're not among the gullible masses that believes the government will protect us from the next economic crisis. I hope you're not part of that group, because if you are, disappointment comes to those who rely on protection from the very institutions who were responsible for creating instability. Lest I remind you, it was my favorite economist, the great Milton Friedman, who warned us and said that many people want the government to protect the consumer, but a much more urgent need is to protect the consumer from the government. And so, what is the key takeaway for us? The key takeaway is that instead of creating economic stability, history proves and shows that the government is regularly and alarmingly causing all of this dangerous instability. And we see that as evidence right now with all of the policy mistakes being made. Now, up until now, it's been mistakes because the market tells us it's a mistake. When you have stocks and other assets zigzagging and going crazy, that tells you right there. That's your report card if you're a politician. And right now, the markets are saying it's a mistake. And again, this rhymes with history. We've seen this before. This is not a shock. This is not unprecedented. This has happened before many times. And it's happened through all types of administrations, Republican and Democratic. And so we get back to creating a safer environment for our investments, a safer environment for our retirement assets. It's essential to protect your wealth from the chaos caused by the government's consistent pattern of bad policy decisions. And how do we do that? Well, by having an adequate cushion, a margin of safety. This is the three cornerstones, one of the three cornerstones of an architecturally sound investment portfolio. And I see investors with a core portfolio with assets that include stocks, bonds, real estate, maybe cryptos. I see non-core investments, individual stocks, leverage funds, inverse funds, hedge funds, active funds. I consider all that non-core. You want to throw meme coins in there, cryptocurrencies, single coins, all that. That's non-core. But margin of safety is an area that a lot of investors miss. And there's minimum safety standards. The purpose of that particular bucket are threefold. Number one, to provide liquidity. Number two, zero market volatility. Number three, 100% principal protection. Not 99% principal protection, not 89% principal protection, 100% principal protection. And as a reminder, there's only three assets that meet those minimum standards of safety. You've got traditional CDs, which are FDIC-insured deposits. These are banking products. You got securities, which are buffered ETFs. We're talking the ones that are 100% principal protected. You still do have some risk there, right? There's the risk the ETF might not meet its objective. But by design, they're built to protect your principal. So just the 100% principal protected or principal buffered ETFs, those are the ones that meet the minimum standard of safety. And then, of course, fixed or fixed indexed annuities, which give you 100% principal protection, zero volatility. And, each of these solutions offers a different perspective. Of course, the annuities is from the insurance industry, buffered ETFs from the securities industry, and then the CDs are from the banking industry. So you got three different industries trying to help investors with the same objective of protecting their principal. And I liken it to, they all can work together. You may have your favorites. Maybe, for example, you might want to use a buffered ETF or an indexed annuity if you're trying to protect larger sums of capital. You're not going to bump into those FDIC limits. So that might be something you look at. But I liken this to, your home. Your home has smoke detectors to protect you from a fire. You've got deadbolt locks to protect you from intruders. And it's not a decision of, should I have the smoke detector and not the deadbolt locks, or vice versa? You have them both because they serve different functions, different purposes. But the whole idea is to keep you safe inside your house. And so regardless of the solution that you're using here, these are the specific types of investments that meet the minimum standard of safety. The whole idea here is to protect you from the financial iceberg. The icebergs that could sink your ship. Things like accidents. Well, we're seeing accidents right now, right? Not just accidents in the street that could disable you physically, but how about massive policy accidents or mistakes caused by government? We're seeing that right now. We've seen it throughout history. So having an adequate cushion or margin of safety can protect you from that iceberg. And of course, there's lots of other icebergs that want to sink you. Speaking of buffered ETFs, ETFK.com is a new all ETF 401k plan that I just launched. I'm going to be doing new episodes all about the ETFK plan, how that works. Those of you that are 401k investors that want to have some protection inside your overall 401k, you're not getting that from mutual funds. You're not getting that from most 401k plans, which don't offer solutions like buffered ETFs, which protect your capital. They give you some growth on the upside, but they limit the downside potential of losses. So ETFK.com, check it out. Go there. And, if you want to get a quote or want to migrate an existing 401k plan to ETFK, you'll get all the information you need there. So go there. Well, I hope you've enjoyed today's episode. We've talked about a lot of interesting things. We've talked about history. We've talked about what's going on in financial markets. Get in touch with me with your comments below. Let me know how you're doing. I'm Ron DeLegge with ETF Guide. Thanks for watching, and we'll see you on the next episode.